All right. Hello, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks. And I wanted to jump on today because we are seeing some historic movement here in a few stocks that you may have never heard of up until the last couple of days. So we're going to talk about GameStop, and we're also going to talk about AMC Entertainment. Most of you have seen in the news, even if you're not trading those stocks, they have been on phenomenal runs to the upside. You're looking at a chart here of GameStop, symbol GME. You can see just over the past 2 weeks, we have basically gone down from down around 15 up to 380 at the highs today. It's all over the headlines, right? What's causing the move? Is it a short covering rally? Is it retail traders trying to stick it to different hedge funds? There's a lot of factors coming into play. So I wanted to highlight some things that we're doing on our side. It's very tempting to want to jump in and take advantage of these moves. It's very easy to turn on the news and hear about these crazy moves and think, I'm missing out if I'm not participating in these types of stocks. But there's some very key points that I want to make today, some things that we want to be aware of because there is heightened risk here over the next couple of days and out to the next couple of weeks. So we're going to talk about that in more detail. As always, if you have any questions throughout the session here today, feel free to type those into the chat here. If you are watching the video, watching the recording, you can certainly post a comment on those videos or email me directly, mike@netpicks.com. We are more than willing to help out. So let me go ahead and turn my camera off here. That way I can make my chart bigger so it's a little bit easier for you guys to see. So this is just a simple daily chart of GameStop. You can see the historic move higher here. I mean, there's an incredible amount of profit if you were a bull over the past week or so. But the big question becomes, what happens from here? Well, let's talk about what's causing the movement. This is not a fundamental move. GameStop, I mean, I've heard it described this morning as a pawn shop for gamers, right? For buying used video games, right? There's no fundamental reason to justify the valuation that we're seeing on GameStop. It's gone from, under $1 billion company to over $10 billion in a matter of days. It's amazing. This is historic. This is not a move that represents a new norm. This is not going to be the new normal that we'll see going forward. Guys, this is one for the record books. I've been involved in the market since 2002. I've never seen anything like GameStop over the past week and a half. So it's a short covering rally. There's a couple of big hedge funds that had large short positions on. And if you're newer to the markets, what is a short covering rally? Well, putting on a bet on a stock moving lower, one way to do that is to sell the shares short. Basically, you're borrowing the shares, you're selling those shares, looking to buy them back at a cheaper price going forward, and you can pocket the difference. The trouble kicks in if that stock moves higher. Okay, you've basically got unlimited risk because that stock can just continue to head higher and higher. And if it does do that, you've got to buy those shares back to close out of your position at a higher price. Well, what happened is those few big hedge funds that had big short positions, they were forced to cover their positions. There was a lot of retail traders out there that had short positions on. They were forced to cover. And on the retail side, it was more of a margin call scenario where as those losses started to mount, those brokers force those traders to close out of the positions. And to do that, they would have to buy the shares back. So you've got all of these large positions being covered, and that's what's driving the stock higher. Those traders have to buy those shares back at a higher price. And that's what's causing this massive move to the upside. Now you add to it, you had to it the Reddit traders, the online retail trading groups that have just been driving the price higher as well. There's just a lot of factors that lead to this type of movement. The trouble kicks in if we go over to the trade page and take a look at GME. The trouble kicks in because this is such an extreme move. The stock is up another 111% here today. We know that that is not a normal move, right? That's never a normal move, regardless if it's an earnings release or any type of a news headline. This is extreme. So the tempting part is to come in and just want to buy a put option with the approach that, hey, this stock can't potentially head higher from here, right? I mean, it's got to be overdone. It's got to be overbought. So the tempting part is to want to come in, just open up the February options and maybe come in and buy a long put. Well, look at what's available out in these February monthly options, the ones with 23 days left to expiration. As of this morning, the highest strike option that was available was 320. This stock is moving at such an extreme pace. It's moving so quickly that these market makers can't even get these strike prices added quickly enough. I mean, they've added a ton of them here the last couple of days, but it's not enough. The stock is just continuing to move so quickly. So that 320 strike is the highest strike that we have. If you come in and look to buy a 320 put, and actually let's just go to a 300 put. If I take a look at buying a 300 put here, you're talking about over $17,000 to buy an individual put option. It's incredibly expensive. Market makers are going to price in the uncertainty. Here's what I'm talking about. Let me just quickly bring up a slide. I like to show this a lot when we're teaching our options course. And it shows you the pricing model of an option. And a lot of times people get involved with options. There's a lot of newer traders that are getting involved for the first time. And you think that it's just stock price that's driving the price movement of an option. The stock price is just one of 6 inputs that go into the pricing model of an option. It is certainly a big input. GME moving up or down is going to have a huge impact on what happens to the price of the option. But another one of those inputs that is having a huge impact on price movement right now is volatility. If we take a look at this pricing model, you've got 6 different inputs that go into the pricing model of an option. You've got the stock price, the strike price, time to expiration, volatility, interest rates, and dividends. All 6 of those inputs go into the pricing model to give you the current price of that option. 5 of those 6 inputs are known. Down here at the bottom, we've got the one input that is the wild card, and it's the volatility number. Basically, the pricing model is going to work backwards. It knows what 5 of those inputs are because they're fixed. But the one wild card is volatility. And the pricing model basically does some simple math there to come up with the current level of volatility that's being used to give the current option price. When volatility is high, the options are going to be incredibly expensive. When volatility is low, the options are cheap. If I go back, now that we know volatility has a huge impact in the pricing model of an option, if I shrink this down here, over on the right-hand side of my platform, you're going to see all of these yellow numbers. These are the levels of implied volatility that are currently being used to price the options. In the weekly options with 2 days left to expiration, there's a 689% implied volatility. Now, what does that mean? Is that high or low? For those of you that are brand new, maybe you're not familiar with looking for volatility numbers. That is an extreme number. I can't remember the last time I saw this type of reading on an implied volatility number. What that means is over the next 2 days, the market makers are pricing in a $173 move higher or lower on GameStop. It's not going to tell you whether the stock's going to move higher or lower. It's just telling you the range that's being priced into the options. If we go out to the February options, the monthly options with 23 days left, you've got a 555% implied volatility level, indicating market makers are pricing in a $724 move on GameStop over the next 23 days. Okay, even if you're brand new to the markets, even if you're brand new to trading GameStop, we can see that for a $300 stock, a $700 price movement being priced in over the next 23 days, that's extreme. Our view on this, if you buy a call option or if you buy a put option here, basically you're banking on the fact that GameStop is going to stay incredibly active and we're going to continue to see those extreme price moves. The problem with that is if the move is not big enough, you could potentially be in trouble because in all likelihood, what's going to happen over the next few weeks is these volatility numbers on the right-hand side, these are going to start to contract. This is not sustainable long-term. If I go back down to the bottom of the GameStop trade page, it'll give you the 52-week range for volatility. If I take a look, we're basically right at 52-week highs. We're at an all-time high for volatility. We just talked about that. But where is a normal range? The 52-week low for volatility is down around 42%. That's a heck of a range, right? If volatility were to start normalizing here, if the volatility contracts, there's an incredible amount of room below us. If we see volatility go from over 500% down to 40, 50%, down to a normal type range, there's incredible opportunity. If that happens, even if it's not that extreme of a move, let's say we go from 500%, let's say we go down to 300%, 200%. When they start to cause that volatility to contract, it's going to cause the options to lose value. Why do I point that out? Because if you come in and buy a put option hoping that GameStop moves lower, not only do you need the stock price to move lower, you need it to happen in a big enough way to offset the volatility contracting. Right? That's the problem that you're going to run into if all you're going to do is buy options here. Not saying it can't work. You just need more to line up in your favor. So what else can we do? Well, first of all, if you're going to trade GameStop right now, a couple things to point out. First of all, keep your risk very, very small. What seemed undoable just a couple of days ago, obviously we can see is very much possible, right? I mean, it's extreme. So anything can happen here. And if anybody comes and says, hey, the stock is absolutely going to move lower from here, no one knows. So keep your risk very small. How do we do that? Because if we go out to the February monthly options, if we buy a long put, we're talking about potentially, $15,000 to $18,000 just to buy an individual contract. A couple other things that we can do. Normally, I would like to come in and sell an out of the money call spread. We've talked about that quite a bit here recently, because if we sell a call spread, if we sell a vertical spread, now that volatility movement that I talked about, now we can potentially put that in our favor. If volatility does contract from here and it does cause those options to lose value, we can make money from that movement. The trouble is, the highest strike here that we have is 320. Okay, so it's going to be difficult because we just don't have any out of the money call strikes to work with. Where if you want to sell a call spread, you're going to have to wait another day or so for them to continue adding new strike prices. So the first option would be to wait, not do anything on GameStop here today. Wait till tomorrow or later in the week. Wait for additional strikes to be added, and then come in and sell it out of the money call spread. Another issue that you're seeing here, if we come over and take a look at the long puts, look at the difference between the bid and ask prices. They're pretty extreme. And these have actually tightened up over the past couple of hours. Earlier this morning, they were much wider than what we're seeing now. There is potentially an $8 move or $8 difference between the bid and ask prices. That's a huge number. Okay, that's going to make it more difficult to get fills on those trades. You do not want to chase here. Make sure if you're going to trade GameStop, you've got to make sure that you're getting filled at a good price or not at all. Meaning use a limit order. Don't just come in and use a market order. Don't just come in and pay full price for an option. You're going to get crushed if you do that here over the next week or so. Place your order, ideally at the mid price between the bid and ask. Place it as a limit order. If you get filled there, great. If not, pass on the trade. Can't stress that enough. Now, another issue, let me get that out of there, is because these options have just started trading. A lot of these strike prices have just been added over the last 24 hours. Notice the volume numbers and open interest. They're very low. There's not a lot of activity here. They just started trading over the past 24 hours, and they're incredibly expensive. There's not a lot of activity there. So it makes it more difficult. I'm not saying you can't trade GameStop. There's just some things that you want to be cautious of. Well, everything that I just got done talking about on GameStop, let me bring up a chart of AMC. AMC Entertainment, right? It's a theater stock. We all know what's going on right now. We're in a global pandemic. This company has not made any money here. And yet the stock is up 180% today, and it's $7 off the high of the session. It got up over 20 today. It was trading just 24 hours ago. It was trading down around 5. This is an extreme move. Everything I mentioned on GameStop holds true for AMC. If you're going to trade it, be very, very cautious. Trade very small size. Don't throw everything you've got at AMC saying, hey, this is a once in a lifetime move. I've got to be in. It's very tempting because everybody's talking about these two stocks right now. It's very tempting to want to get involved because if you don't, you feel like you're missing out. If you're going to trade these products, make sure you're in a defined risk position and make sure you're trading very small position sizes based on your overall account. Now, if we go over to AMC, it's a little bit more doable as far as option prices go, right? If we take a look over here, you take a look and they're a little bit more reasonable, right? I mean, you take a look and you're not talking about $17,000 to buy a put option. You're talking about $400, but the highest strike that we have available is 9. Just like GameStop, they're going to be adding in additional strikes over the next couple of days. They just haven't done so yet. So as of tomorrow, as of Friday, potentially we could come in and take a look at some additional out of the money calls to potentially look at selling a call spread. But right now, there's just nothing that we can do just due to the lack of strikes available. The volatility on AMC, just like GameStop, look over on the right-hand side. Those implied volatility numbers in the weekly options with 2 days left to expiration, 887% volatility right now. They're pricing in almost an $11 move over the next 2 days. Almost 100% move over the next 2 days being priced into those options. That's an extreme move. We know that's not sustainable. In February, there's a 350% volatility level. They're pricing in a $16 move. Okay, a $16 move over the next 23 days. We also know that's not sustainable. In all likelihood, over the next couple of weeks, volatility is going to want to contract. That's why I'm not really looking to buy long puts here on either AMC or GameStop. I am looking to sell call spreads because now I'm putting that volatility movement in my favor. If I buy a put option here, I've got my work cut out for me. I need a pretty big move to the downside to make money because I've got to offset. I've got to have a big enough move to offset the volatility contraction that will take place over the next few weeks. I would rather put that volatility movement in my favor. Now, let's say that you want to put on a trade today. Okay, you're limited because of the lack of strike prices available, but how can we better take advantage of this movement on these two stocks? Let's talk about GameStop. Okay, we've already talked about how extreme this move is. What else could we do to potentially benefit from a move to the downside on GameStop with far less capital being used? Well, another product that we can look at is one of the ETFs. It's XRT. This is the retail ETF. After this huge move higher in GameStop, the retail ETF also following along. I mean, it's up 10%. That's a huge move, guys. I can't stress that enough. 10% movement on a retail ETF. You don't see that very often, if ever. These are historic moves. This is a $90 ETF, but here's why I like it. The volatility levels are still high. Okay, they're still elevated. They're not as extreme as GameStop or AMC, but they're still very high for this product. But when I come in and take a look at the February options, number one, we have more strikes available to us. The options are going to be more reasonably priced when compared to GameStop. And over time, it's going to be a more liquid product. You're going to have an easier time getting fills on this product. Is it a perfect one-to-one correlation type relationship between XRT and GameStop? No, but it's pretty darn close right now. Okay, so what we can do, I want to lean bearish here because this is so extreme. Let me just take a look at the chart. This is an extreme chart pattern, right? I mean, even going back over the past couple of months, this has been a one-way move. Back in August, we were down around 45. We've almost seen that stock price. Well, we've seen it double. It's up 100%. That's a huge move for a sector ETF like this. Price action, very overdone. Very overbought on the upside. I would rather lean a little bit bearish, but I want to do so in a safer way. Here's how we do it. I'm going to go out to the February monthly options with 23 days left. I'm going to go to the out of the money call options on the left-hand side. I'm going to go to the 95 calls. I'm going to right click on those. I'm going to go to sell and I'm going to select a vertical or a vertical spread. Down at the bottom, it pops up an order where I would be selling the 95 call and buying the 100 call at the same time. This spread is currently trading for $1.50 mid-price. So if I click on confirm and send, what does this trade look like? Well, the most I can lose on the trade is $350 per spread. If I am dead wrong, if XRT continues to move higher, if this extreme historic move continues, the most I can lose is $350. We're drastically lowering the cost of the trade. Remember, we're talking about over $15,000 just to buy an individual put on GameStop. Much lower risk. It still leaves me with a bearish position. Ideally, I want this stock to move lower. That's how I'm going to make the money the fastest. if we don't get a move lower, if we just chop sideways, or maybe we just kind of drift slightly higher from here, I can still make money from that move as well. As long as price stays below 96.50, we can make money. The current price is right around 90. I'd have a $6.50 cushion that this thing could continue to move to the upside before I'm in trouble. So any type of stock moving up, down, or sideways, we can make money as long as price stays below 96.5. We also make money from time decay adding up. Every day that passes, that helps me. And top on my list right now, we also make money from the volatility contracting. If we see that volatility start to normalize over the next couple of weeks, we're putting that in our favor. So now I give myself 5 ways of making money on the position. Now I don't need so many factors lining up in my favor to make money. Okay, so I'm risking 350 to make 150. With these spreads, we're typically around risk 2 to make 1. Between risk 2 and risk 3 to make 1 is very normal for us. We're okay with that ratio because we do have those 5 ways of making money on the position. It's going to give us a higher probability of success. Now, are we going to have a home run return here? Am I going to see my $50,000 account turn into a 7-figure account? I've been seeing stories like that here the last couple of days of people playing this extreme move higher in GameStop. That's not the design of this trade. The design of this trade is to allow us to take advantage of the extreme in a safe way. Tie up very little capital, give ourselves a higher probability of success. If you've got a bigger account size, sure, you can take this trade with multiple spreads. You can put this trade on 10 times, have $3,500 of risk. Now you've got $1,500 of profit potential. So you can certainly scale this trade depending on your account size. It's going to be a liquid product. You're not going to have any problems getting filled. How do we manage the trade? Let's say we get filled at $1.50 here today. What I am going to look to do is to buy this spread back over the next couple of weeks, hopefully for a cheaper price. I am going to take a look at closing it out when I can keep around 75% of my maximum profit. The $1.50 is the max profit on the trade. Ideally, if I can buy this thing back for around 37 or 38 cents, that would allow me to keep 75% of my max profit. That would happen if the stock moves lower, as time decay adds up, and as volatility decreases. Any of those routes we can follow to make money on the trade. So if we place this trade today, I can create my closing order immediately for 37 cents. That way the closing order is working over the next few weeks. And if we get any type of a move to the downside on XRT, we can potentially book the profit. Now, everything I just talked about on XRT, you could follow this same method on AMC or on GameStop here over the next couple of days. As they start to add in more strike prices, selling call spreads, you can certainly do it. Just wait for some additional strikes to be added. That way we can go to the out of the money calls and look to sell a spread. That's certainly something I'm going to take a look at doing here over the next couple of days. When will this burst? This is like the tulips effect. Well, historically we've seen bubbles, right? I mean, whether it be the tech bubble, in this case, going way back to the whole tulip mania. Yes, we are certainly in a bubble. I mean, there's been some arguments on that back and forth the last number of months, but after what we've seen on some of these lower priced stocks that have seen extreme moves the last week or so, it's hard to argue with the fact that we are in late stages of a move to the upside. This is typically what happens. You start to get these panic moves towards the late stages of a bull run. Now everybody is just jumping, and people are trading GameStop that have never been active in markets before. They're trading because they don't want to miss out. They don't really know what they're trading. They don't know what the stock does. They don't know what a reasonable valuation is on the stock. They're just buying because that's what everybody else is doing. That's a very dangerous spot to be in. Now, is this bubble going to pop tomorrow, next week, next month? No one knows, right? I mean, there's a lot of factors going into this move to the upside, right? I mean, the Fed and central banks are just pumping endless dollars into this market. So it's hard to fight that. I agree. But when you start to see this type of move, at some point, things will start to normalize. This type of movement, when you start to see stocks double and triple overnight, it's not sustainable. So I don't have a problem trading around these extreme moves. I would just rather do so in a more conservative way. You get caught on the wrong side of a stock doubling overnight, you're on the wrong side, it can be painful in a hurry. So you've got to stay disciplined. You've got to control your risk. Keep that risk very small. There's money to be made right now. There's going to be money to be made here in the weeks to come. This is not just going to be a one-day event here on GameStop or XRT or AMC. These are going to be products that everybody's going to be trading here in the months to come. So when you start to use these risk-defined trades, it's a way to tie up less capital, still participate, and put on a higher probability trade. All right, so just wanted to jump on, talk you guys through some different things that I have been doing on my side to try to take advantage of this move on some of these stocks. So XRT has been my product of choice so far today. And then again, we'll circle back to GameStop over the next couple of days. As we do, we'll come back on Friday for our weekly recap. And we'll see if there's anything new that we can do on GameStop to wrap up the week. I definitely think the opportunity will be there. So if you have any questions, in the meantime, again, feel free to post a comment on the video. You can always email me directly, mike@netpicks.com. But I'm going to wrap this video up here. Enjoy your afternoon, everybody. We do have the Fed on tap this afternoon. It's crazy how much is going on today. Not only do we have these extreme moves in the stocks that we talked about today, but we've got the Fed statement on interest rates this afternoon. We've also got earnings galore after the close with Apple and Tesla with earnings. So just going to be a very, very busy couple of days. So trade safe, be cautious, control that risk over the next couple of days, and we'll talk to you guys on Friday as we jump back on for our weekly recap. What do I think of Apple? Well, Apple, along with the rest of the market, is very, very overbought. I mean, we're basically right up near the highs. The trouble with Apple, you just have so many unusual things going on in this market right now. I personally do not like to trade through earnings in most cases. When I do trade around earnings, I personally prefer to use credit spreads. I do not have any positions on Apple at the moment. I am going to stay flat through earnings this afternoon. I will look to put on a new position potentially over the next couple of days. I'm going to wait for earnings to come out. It's just, for me, earnings, it's hard. You need a lot to go right in your favor because the everything we talked about earlier on volatility is going to hold true on Apple too. The market makers are going to pop up that volatility to price in the uncertainty. And I don't want to get caught on the wrong side of a directional move on Apple and get hit by volatility contracting. So there's too much that has to go right around earnings to make money. So I am not trading Apple. I'm going to stay flat through the release this afternoon. And then come Friday, I will look to get on some new positions once we can evaluate what price has done around earnings from there. So yeah, just not my style to trade earnings in most cases. Not a problem. All right, guys, I'm going to wrap it up for today. Enjoy your afternoon, and we'll talk to you guys on Friday.